I analyzed over 10,000 stocks across various industries, and in this video I will tell you what I learned. In this video I will show you 7 lessons I've learned from analyzing more than 10,000 companies in the stock market. For 10 straight years of research, including some experience in the asset management field for European funds, value investing funds like Voltava Fund, or American funds, I have analyzed on average 1,000 companies every year. So that's 4 companies for every day. Okay, 4 companies per day for more than 10 years actually. So that's a lot of stocks. That's a lot of rocks that have been turned. And the truth is, not everything matters. Not every company matters. If you want to generate some good performance in the stock market, if you want to invest in a good way, the Warren Buffett way, to outperform the market, very few things matter. And in this video, I will tell you what. 99.9% of stocks are just noise. My framework is built to instantly filter out the distraction. So in this video, I will give you actionable tips so that you can improve your process, be faster in your analysis, and become a better investor. So in this video, you will learn how to focus your attention on good stocks only, how to avoid traps, how to not spend your precious time on bad ideas, and you will learn what are the key indicators to monitor. Spoiler alert, not everything matters, only a few things matter. In case it is your first video from this channel, welcome. My name is Christophe Noor. I've been researching stocks for more than 10 years now, and I have achieved a performance of 25% per year. My track record is public. I'm a public investor, and yeah, you can start. The first point I want to share with you, the rule number 1 is paying up for quality. Okay, and for most of the points, I will give you specific examples because I have some experience of doing the mistakes, making the mistakes, so you don't make this mistake. The first one, rule number 1, paying up for quality requires earning resilience. When you pay up for quality, if you want to invest in a quality compounder, sometimes you are willing to pay up a high PE ratio, you must be certain of the sustainability and resilience of the earnings. I have made a fortune out of quality compounders. My whole portfolio right now is filled with quality companies that have been bought at a reasonable price. Okay, this is the reason I'm making 20% per year. But in the past, I have made the mistake of paying up for quality. The number one thing that burnt me in the past was not checking the resiliency of the earnings. Because if you pay up for quality, let's say you have a PE ratio of 40, but this is a great business, so maybe you can pay up PE ratio of 40. If earnings decline, the PE multiples will soar, will increase. You know the ratio for the PE ratio, right? That's the market cap divided by the earnings. So if the earnings are cut in half, the denominator of the formula is cut in half. So the overall ratio is multiplied by 2. This is just math. So if earnings go down, the PE ratio goes up. So you want to make sure of this. If you pay up for quality, please make sure you have a very low chance that in the future earnings will go down. Okay? If earnings are cyclical, if earnings have gone up a lot recently, there is maybe a chance they will go back to the mean. You will have a mean reversion process for earnings, okay? So if earnings decline, your PE ratio multiples will soar and the stock becomes drastically more expensive, not cheaper. This is the biggest risk in buying quality. And I have been burned personally buying Pool Corp. Pool Corp is a company in the swimming pool equipment, and I've been public about this process. I've published videos about this on my channel, if you want to check it, if you're curious. I've bought Pool Corp at a little bit expensive multiple after great years of 2020, 2021. So earnings went up massively in 2020. People were stuck at home because of COVID, lockdown. So people refurbished their homes, their swimming pool equipments, and they had no choice. The budget they had for traveling in the US went from traveling to home renovation. So of course, swimming pool equipment companies benefited a lot. So in 2020, the earnings of Pool Corp went up a lot. In 2021, the earnings went up a lot. And I bought in 2021, 2022, and guess what? 2022, consumer recession in the US, reversion to the mean. Earnings went back down. So I bought at a PE ratio of 30, 35, but earnings went down. So the PE ratio went from 30, 35 to 40, 45. I did nothing. The stock went up, didn't go up. It's just that earnings went down. And eventually, I can show you what I mean right now. I can show you the stock price of Pool Corp. The stock had an immense run during 2020, 2021, and I bought on the way down, thinking it was of reasonable value. But guess what? The stock went nowhere. The earnings were declining. The valuation went up. And for 3-4 years, the stock went nowhere but down. The stock went down 30% in this process. It was a great quality compounder. I had done the work of 20 years of track record. It's just that the valuation was too high. I paid up for quality, and they had 2020, 2021 years that were exceptional for this business. So eventually you will have a reversion to the mean. I did not check the resiliency of the earnings. And I see many people on the internet making this mistake. You buy a company that you believe is quality and you don't do this exercise. Rule number one. This is why it's number one, because it can cost you a lot of money if you do it wrong. Rule number one, you check the resiliency of the earnings. Check if for the past years, the company has maybe over-earned. Maybe they benefited too much from the industry. You will crash down a little bit. Maybe not crash down, but revert back to the mean, which means the PE ratio will change a lot. Okay? Now, since this mistake, I have never done it again. So this is good. I learned from my lesson, and I hope you can also learn from my lesson. Okay, so Pool Corp is a great example, but in the stock market, you have plenty of other opportunities that were like this. If you want to buy something of quality, a good stock that you can buy and hope for the long term, check if earnings will be stable in the future. So you don't get a mistake with valuation, an error rate. Rule number one, paying up for quality, you need resiliency of earnings. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Rule number two, avoid turnarounds. Turnaround plays don't turn around. You have a 95% failure rate, actually. The analysis proves something very simple. Turnaround plays almost never turn around. The time and capital consumed by struggling companies, so legacy retailers, old companies that are not going the digital way, distressed industrials, are rarely worth the risk. Stick to excellence. And if you want some quality investors that are doing this, if you want to focus on the best and copy the best investors, you have Dave Cantesaria, you have Chuck Acre, and Chris Hahn. Maybe you can go on ChatGPT, on Gemini, and ask ChatGPT what their investing style is. They will tell you how to stick with excellent companies, how to stick with excellence and and avoid turnaround plays. Most of the time, and I would say almost all the time, turnaround plays don't turn around, but they can be appealing. They can be very appealing, very cheap, very sexy, so you may be tempted. Now is the time to have discipline and not be tempted. It's the time to just look away from this turnaround play that is cheap, because most of the time problems keep accumulating, piling up, and it's too much work and it's time consuming. It gives you anxiety, and the CEO leaves, and then an operation shuts down, and then they have another problem, and then they have a new competitor, and it's a mess. Why do you want to be invested in messy companies when you can invest in excellent companies, available at a good price, fair price, but excellent companies? You have two kinds of investing, right? Investing with anxiety, investing without anxiety. Why do you want anxiety in your life, right? Life is stressful enough. Just stay away from turnaround plays. I've studied too many businesses that were in this situation. Almost all of them did not go well. This is what I have learned from history, and I know right now for my own portfolio, I will never touch turnaround plays. Okay. Rule number 3, founder-led management and ownership. Really important. The ultimate green flag, if you want to be investing in the long term, is to be invested in companies with high insider ownership. Nothing beats management led by a founder with high insider ownership. You have a few examples right now. You have Mark Zuckerberg and Meta Platforms. You have also MSCI. You have also Fortinet. They have a management team that is the owner. For Fortinet, you have the Zia brothers. So Zia brothers, they own 15% of the company. The CEO and the CTO. 7%, 8%. The management team owns 15% of the company. Mark Zuckerberg owns, I think, 13% of the company. Mr. Fernandez owns 3% of the company. You want 3, 5% minimum. And in the very long term, a company that is focused on efficiency, long-term shareholder returns, will beat the market. So eventually, if you want to pick the best stocks, the best portfolios that will beat the market, maybe you can build your portfolio only with companies like this, with a founder-led management team. This creates an alignment, and this is a massive incentive for long-term growth. By the way, if you want to check the insider ownership, I can show you how to find it pretty easily on Fiscal AI. Let me give you the tools on this video. Let me take the time. Okay, so Meta Platforms. Meta. You go to Fiscal AI, you click on ownership here, and you click on this, insiders. Owned. Mark Zuckerberg owns 13% of Meta Platforms. Okay, that's big, and that's by far the largest ownership from an insider. Okay. Same thing for MSCI. Henry Fernandez owns 3% of the company, 2.8. And that's by far the largest ownership from an insider. And the third example I gave you was Fortinet. Same thing, you click on ownership. Ken Zia owns 8% of the company. Michael Zia, his brother, CTO, owns 7% of the company. Okay? This is the ultimate green flag if you want to be invested for the long term. By the way, if you are not using Fiscal AI, you can use my discount code in the description. You will get the website for 15% cheaper. It's one of the best investing websites you can have. I'm using this on a daily basis. If you don't know which subscription to use, you have discount codes in my description. Okay, so I highly recommend you use Fiscal AI on a daily basis. This is one of the best websites you can have. Okay? In a world that is changing faster and faster, ownership is key. Oh, okay, this is pretty good. Let me use the note and note. Note number 1. Low insider ownership is not necessarily a red flag, but this powerful alignment is absent. Okay? Now imagine you are studying a company and they don't have a founder-led management team. You don't have high insider ownership. Is this a red flag? I don't think so. It's just not a green flag. I started this point by saying it's the ultimate green flag. But the fact that the company doesn't have a founder as CEO is not a red flag. If you look at Uber with Dara, he joined in 2017 or something like this. He's not the founder, but he has done some great work. If you look at plenty of other companies, they don't have the founder as CEO, but they are doing fine, okay? It's just not a green flag. Okay. Note number 2, high insider ownership is even more important in changing industries like AI. For Mark Zuckerberg and Meta Platforms, they are in the eye of the storm. So you want the CEO to be the founder, to be the boss here, because he has ownership. He will take massive decisions. For some companies like Visa and MasterCard, it's less important because the business is not constantly changing. In the next 3 years, Visa and MasterCard will be the same businesses. In 3 years, Meta Platforms will be drastically different. They will maybe have some new monetization engines, more data centers involvement, more debt, more pressures from AI for the AI bubble. What are the costs, the LLM, the build out? Many uncertainties. The more an industry changes, the more insider ownership you want. They take ownership, they take accountability, they are the boss, they take massive decisions, okay? So I hope you get the distinction here. The high insider ownership is even more important in changing industries like AI. Okay, rule number 4, concentration versus diversification. The monitoring trap. It is impossible to truly monitor 100 stocks. You must have a concentrated portfolio of 10, 20, 25 stocks maximum to understand crucial changes quickly and build conviction. I have worked with more than 300 clients right now, and some of them come with me. I have a coaching program, this is why. Some of them come before joining the coaching program and they have a portfolio of 100 stocks, 200 stocks. And I ask them the same question. Do you monitor all of them? Or do you just skim through them? Like, do you really do the work? Listen to the earnings call, read the reports, see what competitors are doing. All of my clients are saying no. When I have a portfolio of 100 stocks, I don't have the time to monitor 100 stocks. So I have deep conviction that it's impossible to monitor many stocks at the same time, because monitoring stocks takes time and you don't have the time. You are watching my channel. I know the age group of my channel overall, on average, you are 40, 50 years old on average. You probably have children, you have a job, you don't have the time. I mean, you are a retail investor, not a professional. You don't have the time to do this full time with monitoring of hundreds of stocks. It's impossible. Why do you want anxiety in this world? Once again, you just focus on a few quality companies that you know really well. You build conviction, concentration in your portfolio, and you outperform the market. Don't try to add complexity into your life. Okay, your life is complex enough. So a concentrated portfolio beats everybody. This is what I have seen across many portfolios and many years of investing and research. Okay, at some point you will think, yeah, diversification helps me in case something drops. So something goes up, something goes down. If I have like small ownership, it's okay. I won't be destroyed if something goes to zero. Yes. Okay, so don't own 3 stocks. At some point, you have research saying that from 12 stocks, diversification doesn't help you. From 12 stocks on, the diversification is not that helpful. Okay? So I have a portfolio of 12 stocks. So this is the perfect amount of stocks to have actually. So yeah, if you have 12 or 25, 35, 45, the diversification effect is less and less important. It's a logarithmical rule here. So yeah, you don't want diversification in your portfolio. Concentration beats everybody. The ROIC consistency test. ROIC means return on invested capital. Rule number 5, the ultimate moat metric. The analysis showed that businesses with 10-year track record of 15% returns on invested capital are true compounders. This proves consistent value creation. Okay, how do you know if you invest in quality stocks? How do you know if you invest in quality companies? How do you know if this is a trap or not? Well, you can check for the past 10 years what has been the ROIC, return on invested capital. You have financial websites, including Fiscal AI or Stock Unlock. Discount codes in my description, by the way, just below. You can check the past 10 years and if the ROIC was high or low, if this was cyclical or stable, steadily growing or steadily declining. You can check this. My golden rule is to have a ROIC above 15% every year for the past 10 years. Boom. If you don't have this, you discard the investment. If you don't have 15 years minimum, you just remove, you go on to another stock. I have analyzed thousands of stocks. And if you have a minimal ROIC, it's not good. You will not make 20% per year if you invest in bad companies. You want efficiency beasts after all. You want to beat the market. You want to be invested in quality companies that will have a very good performance in the future, that will give you minimal anxiety, very low stress, and you will outperform the market. On average, the companies that outperform the market are companies with a very high level of efficiency. How do you judge efficiency? 50% ROIC for the past 10 years. Okay? Consistent value creation. Be careful. Also, be careful with return on equity, ROE, as companies can cheat. Now, here is a small exercise for you. Quick exercise for you. This is a question. I mean, this is an interactive way of making a video right now. Question for you right now. Pay attention. How can a management team cheat on return on equity, ROE? Let's say the management team is incentivized to boost return on equity, ROE, to get a nice bonus at the end of the year. I will let you 5 seconds to answer this. How can a management cheat? If they will get a fat bonus at the end of the year and they are judged whether they increase the ROE or not, how can they cheat? The answer is massive debt and buybacks. If I'm the CEO of a company and I am judged if I increase my return on equity, ROE, let's see what we have. The formula for the ROE, ROE, return on equity, is very simple. That's your net income divided by your equity. If you want the return on equity to go up, you can either, how can I show you? I can show you in red. If you want this to go up, you can either increase your net income or you can decrease your equity. Well, you are not magician. So maybe if you are the CEO of a company, you can't increase your net income because your business is stable. Let's assume you have a stable business. Well, you can cheat by reducing the equity, by decreasing the equity. How do you reduce the equity? Next question for you. You have a few ways to reduce your equity. One of them is doing buybacks. How can I show you? In brackets, buybacks. Sorry for the bad writing. So you can do massive buybacks. Massive buybacks will reduce the equity. That will increase the return on equity. How can you fund buybacks? Maybe you don't have cash in your balance sheet. Buybacks is you use your cash to repurchase your own shares. Maybe you don't have cash in your balance sheet. Okay, let's go to the bank. Let's go for a massive loan to the bank for maturities of in 2040. So you take the interest rate, you don't care. You take massive debt, long-term debt, and you use all this massive debt to do a massive buyback. And this massive buyback program will massively reduce the equity. And some companies are doing this. Some companies are doing some financial engineering to do a lot of debt, reduce the equity, and if you reduce your equity, you increase your return on equity, which means the ROE is not a good indicator of value generation because management team can cheat. Okay, you can always cross-read different metrics, but this is the reason I am using return on invested capital, because you take into account the debt, for example. Okay, be careful of this. Rule number 1, the ROIC consistency test. Be careful when you check the return on equity because people can cheat. Rule number 6, pricing power and gross margins. Here is another moat indicator. Strong gross margins. Strong gross margins prove pricing power. If a company can't raise prices without losing customer, it's a commodity. Only focus on companies with strong pricing power and high margins. If you want to have a good performance in the stock market, if you want to invest in stocks for you, for your children, and you want some decent returns, you want to be invested in companies that are growing. Now we live in a world with inflation, 3-4% inflation. So you want to be invested in companies that will offset inflation. Companies that can increase their prices by 3 or 4% minimum. An example is Moody's. Moody's has been doing so for many decades. It is working. Moody's has pricing power. Moody's is a company that has the ability to raise prices and customers will not complain. Okay? If you only have this quick test of can you increase your prices more than inflation, you can discard the majority of businesses. Thousands and thousands of companies that are struggling with a lot of cost, capital-intensive companies. Okay? You only select the best companies. How can you judge if a company has pricing power? One, you can check if they raise prices as much as inflation or more. Two, you can check the gross margins. This is almost the same. So gross margins, gross profit is the profit revenue minus COGS, cost of goods sold. So minus your cost of raw materials, for example. You want the gross margins to be as high as possible, actually. If you want to use a small screening tool, by the way, you have a screener tool on Fiscal AI. So you can use the screening tool on Fiscal AI. You can screen for high margins, high gross margins, higher than, 60%, for example. The higher the gross margin, the better the pricing power. And if you want to be invested in a world with inflation, you want to be invested in companies with pricing power. So check what are the companies with immense gross margins, very high gross margins. This is a beautiful way to invest. And I know for my company, the average gross margin for my 12 companies in my portfolio is 65%. So very high, very, very high. I only want to be invested in companies with pricing power. It's a great indication of a moat, of a quality superior business. Rule number 7, the debt filter. In investing, you will see companies with a lot of debt, some companies with no debt whatsoever. You want the balance sheet to be very simple. After reviewing thousands of balance sheets, I learned to immediately discard any business with complex, aggressive debt structures. A clean balance sheet makes sure survival during crises. If you are hit by the great financial crisis or just a crash, you want your business to survive. You don't want to go bankrupt. So you can reverse engineer. How can you go bankrupt? With leverage and debt. So as a form of reverse engineering, a way to never go bankrupt is to never have debt. So maybe you want to completely avoid debt. Very minimal leverage or no leverage whatsoever. You want balance sheets that are very, very simple. Just in case something bad happens to the economy, a clean balance sheet will help you survive. People forget this in good times. When the stock market is going up, people really don't care. People just look at growth and the income statement. But in bad times, balance sheets are very important. Okay, here is the conclusion, the power of focus. After all this analysis, my time is now spent focusing on the few best businesses. Because of all these rules, no debt, pricing power, high ROIC, etc., etc. Okay, analyzing more than 10,000 stocks didn't only teach me which stock to buy, but it also taught me which 9,990 stocks to instantly ignore so that I can build my dream portfolio of roughly 10 stocks. And that is the skill that generates real wealth. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.